Hello, everyone, and welcome to our exciting lecture series on financial accounting. And I'm your instructor Jamal. Hi there. Today we are covering the long term liability and honors equity. So, today is the last lecture of our accounting subject. So, let's don't waste time and continue that. So, learning objective is that account for the bonds payable, notes payable, and interest expenses. Let's talk about that. So, what are bonds? Bonds are debts issued by the companies. So, they are issued in the form of certificates, and on that, there's going to be a company name. On the face of the bond, there is a written principal value. We also call that face value, maturity value, or par value. These are the other names of the principal of the amount that the company issue, or at the end or at the expiry of the date the company will give back its loan, right? For example, if company issue $1,000 value of bond, then at the end of, for example, for 5 years, so at the end of 5 years company will pay back $1,000. So this $1,000 is also written on the face of the bond. That's why it's called that face value. And at the end of the maturity period, company will give you back this 1,000. So we also call this the maturity value. And par value we also discuss in our coming slides as well. So remember, so what are written on the face of the bond, we also call that par value. Okay, maturity date, like what time this bond is going to be mature or retire or expired, right? The interest rate, of course company is going to be using these $1,000 for 5 years. The company going to pay you, for example, 10%. 10% is the interest rate. So except all of the above, there is one other characteristic, that is interest payment dates. For example, whether it is yearly, we call that annually, right? Annually, there's going to be semi-annually or quarterly or monthly. Okay, so these are the interest payment dates. So there are types of bond. Number one is term bond, which is a normal structure of the bond in which you pay money. For in our previous example, $1,000, you pay $1,000, you receive 10% interest, right? And after 5 years, so that is the basic structure of the bond. We call that term bond. Serial bond, we also call that installment bond, in which you receive the interest plus principal from time to time, right? So it means the installment you're going to pay to retire this one, for example, every month you will be given, so sorry, every year you will be given $1,000, right? You paid $1,000, or okay, you will be given for 5 years. For example, you're going to be paying back 300 for every year, right? So every year this 300 involves some principal and some interest payment. So this kind of structure is called serial bond, and the other name is installment bond. Okay, and the third one is, let me just remove it here. The third one is secure bond. We also call that mortgage bond, in which you you know you receive loan and you guarantee, or for example, if company issued $1,000 loan, and companies say that, look, if I cannot pay you back, so here is the property, the building, office building, or the like factory, so there's some kind of security behind the issuance of the loan, so that the person who is providing loan, he is secured, right? And the unsecured bonds, we call that debentures. So you give this 1,000 and you don't have any security, you don't have asset to secure, and the company did not announce that, okay, if we cannot pay you, then then wait for liquidation, or wait that we cannot pay you back, and we are like insolvent or liquidant, or we are bankrupt, just like that. So chances of that you are not chances of that you are not given back your principal amount is higher in unsecured loan. And to cover up that, usually companies also include some kind of premium, some kind of extra interest rate as well. For example, in normal, if they pay 10%, then here they will pay you 12%. The interest rate in unsecured bond also higher. Okay, now the bond prices. Normally bonds are quoted at percentage of maturity value. Maturity value, which means face value, right? So if bonds are quoted at face value or maturity value, we call them that bond is issued at par, right? So if bonds are sold, for example, if company issue bond of 1,000 and it is quoted at 100, or you can say that it is, if company issue bond and receive exactly $1,000 for every bond it issues, right? So normally bonds are denominated in 1,000 value. For example, if company needs $1 million amount, right? How many bonds company need to issue? Divided by normally 1,000. Answer is 1,000 bonds, right? So if company issues one bond at face value, or also it receives exactly $1,000, so we call them, it is sold at the amount at par, right? Number two is, if company issue bond for 1,000 but receive in excess of face value, right, or maturity value, right, we call that it's issued at premium. And how much is the premium here? Company receive extra $15, right? Company will pay you how much amount? Exactly 1,000 back. So at the maturity value, the company will give you back $1,000. But right now you purchase that bond at 1,015. Extra 15 you pay. We call that its premium. So we show it here with the excess of par, or the quoted price gonna be 101.5, right? Okay, so if company issue $1,000 but receive, or people pay you less than 1,000, in this example here we call that discount, right? And it is quoted as, for example, less than the par is always 100. If above 100, we call that it is premium. If quoted price is less than 100, we call that it is issued at discount, right? So there is no hard and fast rule here. It is just to make you understand that it is on the premium or on the discount. So bonds can be denominated is more than 1,000, but normally the one bond value is $1,000, right? Okay. So here, the same thing that we just discussed in our previous slide. Just I'm gonna go here a little bit fast. So just pause the video and read it by yourself. I'm just gonna repeat it a little bit, quickly here. So premium means price above face value. It has a credit balance. Why? Because you receive extra money, right? And you treat this money as a reserve, right? And reserve are treated as credit balances, right? And why is that? Because market price decreases towards maturity value, right? We'll talk about in our coming slides. Discount means there's a price or below the face value. We call that here discount. And discount is kind of like expense. So expense has always debit balance. We treat it as a debit balance here. And why is there is a discount? Because market price increases towards maturity value, right? So at the maturity, when the life of the bond is over, the life of the debt is over, face value is equal to market value, right? Okay. So in